this is a Goldman CD, and you can tell that this is just a certificate of deposit, quite simply, which is pretty much the same as a CD that you get in your bank, which might pay 1 or 2%. However, this is an equity index linked CD, which is now being offered by a lot of investment companies. And what they do is they link the return of your CD to an underlying index and try to match the returns. Of course, your maximum monthly index return is capped at 1.5%. I'm going to get my highlighter here just to show people some of these wonderful benefits. So if the market does really well, you're capped. Who keeps the difference? The investment company. It's quite astonishing the length of the disclosures that people have to sort through to understand exactly what they're getting themselves into. For this particular CD, it's about 57 pages. So you need 57 pages to actually understand what you're getting yourself into. It's like I said, again, it's quite astonishing to have this much disclosure. It's great to inform investors, but the problem is nobody's going to read this. And these CDs are actually quite new. There was an article about them in Bloomberg, actually, that recently came out. Put this up on the screen here. Like the structured notes, these investments are tied to the market in some way. However, they actually do have a benefit where they are FDIC insured. Now, you'd think, well, okay, well, it's a CD, it's FDIC insured, it's linked to the market, so you might as well get some potential upsides. What's the downside? Well, let's take a look at an example that was outlined in this article. Union Bank is offering a 5-year CD this month tied to the Dow Jones UBS Commodity Index with gains capped at about 30% if the index rises. In one scenario, to earn the equivalent of 5.38% annual interest, the index would have to be close to at least 30% above its initial level at maturity, according to the bank's 42-page prospectus. The minimum return is a little less than 1% over the term of the CD. Basically, whenever clients go into these kind of securities, they're making a bet with the financial institution that the market is going to be a certain way. The institution has its idea, and of course it tries to sell investors a different idea, and whoever ends up winning that bet is going to be on the winning side of this security. There's almost never a situation where Wall Street gives out freebies, and there are no freebies in finance. People usually forget this, unfortunately. So really the thing to concentrate on here is a lot of these securities, the CDs, the structured notes, they have very limited upside, and in some cases they don't have adequate downside protection, no matter what the salesperson might say. And the average investor just really has to look closely to find out exactly what they're investing in to see whether that's the right investment for them. And I'm not trying to scare people. There's plenty of great investments out there, but unfortunately investors are always forgetting to do their due diligence and fortunately are being led in the wrong direction by the financial industry. And it's really embarrassing to say that, being part of the financial industry, but my whole goal is to actually go against that and to help people find a better way. So at this point I want to get to some questions. It went a little longer than I anticipated. I had a lot to say here. Actually, I had another topic which I'm going to skip for this time, but I might cover next time. And the question is, when does CPA protect investors? ETFs, REITs, structured products, so forth. Now, CPA doesn't protect the market value of your securities. So the question is, in which case does it protect you? In neither of those cases does it protect you. You're not protected. You're relying on the credit worthiness of the issuer. That's it. The company goes out of business, you're out of luck. The whole idea of CPA protection is, so if you have your assets custody to Bank ABC, that up to a certain point you are protected in case they become insolvent. However, none of these securities have that protection, unfortunately, and that's something that's not adequately communicated to investors. So that was a great question. Aside from that, I want to thank everybody for joining me today. It's really good that people want to get the inside scoop on what's going on and become more educated about the markets. I'm more than happy to answer any questions. Please feel free to reach out to me at athelonwealth.com, or even better by phone. I'm available at 347-706-1414, and I'm more than happy to answer anybody's questions. I have my contact information up on the screen here. Like I said, my whole goal is to make sure investors are aware of what they're getting into, that they feel safe and can sleep at night, because that's really the ultimate goal. And I'm going to continue to go through the nonsense in the financial industry and bring people the truth look in the future for more updates and future events. Thank you so much. Bye-bye.